Welcome to the deep dive. Today we're taking a major shortcut into some pretty high-level market analysis. We're unlocking key insights from the 2016 Inner Circle Trader Mentorship, and we're zeroing in on month '03's curriculum.
That's right. And if you're a learner who's really committed to understanding how institutional players genuinely view and, manipulate price, this is your blueprint.
It really is. Our mission today is to give you that framework to define your own approach, spot where the smart money is moving, and, this is the big one, learn how to avoid becoming liquidity for the market makers.
Exactly. We're moving way beyond just surface level charting. We're going to align the biggest economic drivers, these huge macro forces, with the smallest, most precise technical entry points.
Okay, so let's unpack that. We're talking about integrating everything from these colossal shifts in global interest rates all the way down to pinpointing micro entries.
And confirming those entries with things like liquidity runs and even specific times of day. This integrated view is what separates simple pattern recognition from, well, institutional flow anticipation.
So where do we even start?
Before we can even talk about a single trade, we have to start with self-assessment. The absolute foundational step, according to the source material, is defining your role. What's your role in the market? And that's based on time frame and, just as important, your psychological fit.
I like that. So it's not just about data, it's about temperament.
It has to be. You just can't trade like a day trader if your personality demands the kind of patience a position trader has. It won't work.
Okay, so the source lays out a pretty clear hierarchy here. Let's start at the top. The monthly chart. Who is that for?
The monthly is reserved strictly for position trading. We're talking about finding the largest structural swings in the market. This requires an extreme level of patience. You might only be placing a few trades a year.
A few trades a year. Wow. Okay, so scaling down from that, we have the weekly chart.
Right. And the weekly is for swing trading. It's typically, one or two really well-defined trades every quarter. It's essential because it frames your short-term analysis, but it still demands that you step back and really trust that longer-term process.
Now, this is interesting. The daily chart is singled out in the material as the best chart for short-term trading. That seems to make sense, but why is it better than, say, a 4-hour chart if your goal is execution? Wouldn't that be faster?
That's a great question, and it's a critical distinction. The daily chart contains two things. The lower time frames tend to distort, first, the true interbank levels, and second, it gives you that necessary long-term perspective. It filters out so much of the noise.
I see. So the lower you go, the more noise you get.
Precisely. When you drop to the 4-hour or less, you are firmly in day trading territory. Yeah. And that means your risk management, your execution window, it's all compressed. You're expected to be flat out of the market by 2 p.m. New York time. If you can't handle that pressure, the daily chart is your home base.
So once you've identified your chart, your time frame, then you have to define your model, right? Your actual identity as a trader.
Yes. You have to commit. Are you a trend trader, only moving in the direction of the monthly and weekly? Or maybe a swing trader, working with the daily chart's intermediate moves?
Or what about the opposite, the contrarian trader?
Exactly. Someone who specializes in hunting for those high-probability reversal patterns, but only at market extremes. You have to pick one and stick to it.
Okay, so we've nailed down personal identity and time frame, but now the big question. How do we figure out where the market is actually trying to go over the next, say, 3 to 6 months? This is where I think most people get completely lost in headlines and news.
They do. And this is where we put on a pure institutional lens. We're going to interpret macroeconomics visually just by looking at the bond market.
The bond market.
Specifically, the 30-year Treasury bond and the 10-year note futures. These instruments, they're the leading indicators. They reflect what smart money is positioning for in long-term credit and interest rates.
That feels a little counterintuitive for a currency trader.
Yeah.
How do bond futures tell me anything about, say, the British pound? What's the mechanism there?
The mechanism is the inverse relationship between bond prices and yield, or, interest rates. If the price of those bond futures starts to decline, it means institutional players are selling bonds aggressively.
Okay.
And when bond prices fall, the long-term interest rate has to rise to attract new buyers.
So bond price down equals interest rates up.
Yeah.
Got it. But why does that strengthen the U.S. dollar?
Because when U.S. interest rates become more attractive than rates in, say, Europe or Japan, global capital gets drawn back into the US dollar. It's a massive capital flow. It's a sustained multi-month movement. When you see those bond futures declining, that is your signal for a bullish long-term bias on the USDX.
And that's the engine that provides the context for every other currency pair.
It's the whole context. And the source material points out that these shifts often align with quarterly cycles. You should expect a reversal or at least a long consolidation about every 3 to 4 months.
Which ties into institutional accounting cycles. That makes perfect sense. So to confirm these big shifts, do we just watch the press?
No, we applied the SMT, the smart money tool divergence concept at this macro level.
Yeah.
We actually compare the 10-year bond versus the 30-year bond and then compare those against the USDX.
So you're looking for a failure in symmetry at the highest possible level.
Yes. If the 10-year makes a lower low, but the 30-year fails to confirm it, that non-symmetrical move is a huge tell. It predicts a long-term shift is brewing because not all parts of the bond market are aligned.
It's a crack in the foundation.
It is. It clues us in on what institutional money is doing, what they're accumulating or distributing, long before the average trader sees it in the daily price of your SDS.
Okay, so let's bring that concept down to the charts themselves. We have our macro bias from the bonds. How do we confirm that thesis is playing out right now using the dollar index against, say, the euro?
We're looking for the same principle, symmetry versus non-symmetry. In a healthy trending market, if the USDX trades lower, the USD should trade symmetrically higher, a nice, clean, higher high. When you see that, the trend is strong. Don't fight it.
But the real opportunity, the real signal, is when that symmetry breaks down, the SMT divergence.
That's the signal for manipulation, is where they gather liquidity. So imagine the USDX makes a new lower low. That implies dollar weakness, right?
Right. So the euro should be making a new higher high.
It should. But the divergence happens when the USD fails to make that higher high. Maybe it just forms a lower high, or what we call a failure swing.
So the dollar went down, but the euro didn't go up as much as it was supposed to. That failure is the fingerprint.
It's the fingerprint. It suggests there's underlying strength, aggressive accumulation in the US dollar.
Yeah.
Big players were not willing to let it go lower. When you spot that, you know the trend is likely not intact, and stalking a reversal becomes a very high probability trade.
You're basically trading against that symmetrical expectation, all based on the divergence.
Exactly. You see that strength in the USDX via divergence, and you instantly shift your focus to selling the foreign currencies because you know the dollar is probably about to push everything else down.
Okay, bias, check. Confirmation, check. Now we need the actual setup, the fingerprints of institutional money that validate an entry. This is what the source calls institutional sponsorship.
Right. And institutional sponsorship is all about the impact of large entities entering the market. It's an immediate, dynamic, almost explosive response to protect a specific price level.
And if the move is slow or choppy,
If it's lackluster, it means there are no big institutional orders there. That's a huge warning sign. You should probably reconsider the position.
So let's break down the 4 essential criteria for a high probability long setup. What's number 1?
First, you need higher time frame price displacement. A strong, dynamic move away from a low that just screams reversal or expansion, shows clear intent.
Okay, intent. What's next?
Second, an intermediate term imbalance. This usually means prices moved back into a discount area, the lower half of a recent range, or, and this is critical, a clear sell-side liquidity run below recent swing low. They have to sweep the stops to fill their orders.
So they sweep a low to get in. What are they targeting to get out?
That's number 3. Short-term buy liquidity above the market. Those are your targets. Institutions need to pair their long exits with willing buyers, and those buyer stops are resting right above recent swing highs. No clear target, no trade.
And the 4th, which you said is non-negotiable.
Time of day influence.
Yeah.
These sponsored setups happen during the high activity windows, a London open low or a New York low formation. The big banks are active during these sessions, and your entries have to align with their hours.
And obviously the inverse is true for shorts. You're looking for a move to a premium, a buy-side liquidity run, targeting sell-side liquidity below, all happening at a London or New York high.
And a key refinement to all this is identifying order blocks. A bullish order block, that last down candle before a big surge, or a bearish order block, the last up candle before a collapse. If those form during London or New York, they become critical reference points.
Why are they important?
Because that's precisely where the initial institutional entry happened. They are likely to recapitalize and defend that level because they still have open interest there. It's not just a candle, it's a historical location of a massive order.
It's where the money is. Okay, let's pivot to the dark side of this. The traps, the sucker plays that institutions use to get the liquidity they need.
The first one is probably the most common, the trend line phantom. You know, those diagonal support or resistance lines that retail traders absolutely obsess over,
Right, they connect 2 or 3 points and then buy on the third touch.
believing it's some kind of organic support.
Mm.
But the institutions, they aren't looking at those imaginary lines. They only care about one thing: large, concentrated pools of liquidity.
So the trend line is just bait.
It's the line of cheese leading the mouse to the trap. When retail buys heavily at that diagonal support, the market collapse that follows is engineered specifically to run the huge pool of swing low. Sell stops resting just below the previous horizontal swing low. The trend line is the distraction. The horizontal low is the target.
And the other big trap the source highlights is the head and shoulders pattern. How does that get weaponized?
Well, classic head and shoulders is bearish, right?
Mm.
So if you see that pattern forming at a long-term low when your higher time frame context is actually bullish, that is a massive trap.
I see where this is going.
The market lets the neckline break, which triggers all the sell stops from the retail shorts. Institutions then happily buy all those stops. That's a classic turtle soup long entry. And their new target becomes the buy stops resting above the head.
They use the bearish pattern to get the fuel they need to go long.
And conversely, an inverted head and shoulders, a bullish pattern forming at a long-term high when the context is bearish. Same trap, just inverted. They will sell aggressively into the buy stops above that neckline to fuel their shorts. The pattern itself is the inducement.
Okay, to make this all practical, the source suggests a specific practice routine. What should someone do to really solidify these concepts?
First thing is to streamline your focus. Don't try to master everything at once. Just concentrate on 3 core setups: order blocks, stop runs, or turtle soup and liquidity void fills. That's it.
And what's the homework assignment?
Okay, here it is. Go back on a daily chart. I want you to find 10 instances of a known high being run. That means a short-term high is taken out by just a little bit and then followed by an immediate dynamic reversal.
10 examples of a stop hunt. Then what?
Then, for each of those 10, go check the USDX foreign currency SMT Divergence before the stop hunt happened. Did the divergence exist to give you the green light for reversal? That's the practice that moves you from being a pattern recognizer to an institutional flow anticipator. You have to see the divergence first.
So what does this all really mean for someone trying to learn this? The complexity just seems to dissipate when you align your entry, the micro detail, with that institutional perspective.
It does. Your job is to define your own setup and then use the higher time frames, monthly, weekly, daily, to give you that directional context.
We're always verifying with the bond market and the SMT divergence.
Always. That integration removes the ambiguity, it removes the guesswork, and it just drastically increases the probability of your execution.
Thank you for joining this deep dive into institutional market structure.
It was my pleasure.
And a final provocative thought for you to consider. Given the fractal nature of price and institutional sponsorship, if price returns dynamically to a specific order block, that historical entry point, for a second or even a third time, what does that willingness to continually recapitalize and defend that specific level tell you about the ultimate liquidity target they're trying to reach much further out on the chart?